This is one of my favorite ways to view HSAs in the context of someone's retirement plan. Let's assume that you have an HSA, and let's assume that you fund it, just for easy numbers again, with $5,000 per year. Well, there's two different things you can do with this. Let's also assume that you have $5,000 in medical bills in this year. Well, if you have expenses of $5,000, the traditional thinking, and it's not bad thinking, but what most people tend to think is, okay, I'll take this $5,000 and I'll pay for those medical expenses tax-free. So that $5,000 I've never paid taxes on, I pull it out tax-free to pay for my medical bills. Well, let's say 20 years goes by and the same exact thing happens. You have $5,000 of funding to your HSA, you also have $5,000 of medical bills, and this same thing happens for 20 years. What would happen over that time period is you would have put $100,000 into your HSA to pay for $100,000 of medical expenses. So it was still a very strong benefit for you. That $100,000 that otherwise would have been taxable was completely tax-free to you. Now here's where the planning point comes in. Let's assume that instead of doing it this way, what if you still had an HSA and still had expenses each year, and you still put $5,000 into your HSA, and you still had $5,000 in medical expenses? Well, what if in this case we took funds from cash flow? So we took funds from cash flow each year and we used that to pay the $5,000, allowing our HSA balance to continue to grow, because remember, you can invest those dollars so those dollars can grow for you. Let's see what happens in this case. So you do this, and again, you do this for 20 years like we did in the previous example, but now these funds are growing at 8% per year. Well, what that means is by the end of 20 years, so $5,000 per year growing at 8% per year, you now have $289,000 in your HSA account. Think about how powerful that is going into retirement, where many people's biggest concern is, oh my goodness, what's it gonna cost for medical expenses? Whether it's Medicare premiums or health insurance premiums if you retire before 65, or just the cost of medical bills, think how powerful it would be to have a lump sum of money there that you could draw tax-free at any time to pay for all those bills. So yes, in this example, it did mean you had to come out of pocket $100,000 to pay for all these medical expenses, but in exchange for that, now what you have is you have $289,000, $189,000 of which is just growth on your dollars. So that's almost free money, not free because you grew it and you earned it, but that's $189,000 more dollars that you now have to pay for your medical expenses that you wouldn't have had you use your HSA balance on an annual basis to pay for medical bills. Now, this does require using cash flow. So this does require having the excess funds available to do this, but if you can, it can be a really powerful strategy because it's enhancing what you have available to you when the time comes to retire and you start paying some of those medical expenses. Once again, I'm James Knoll, founder of Root Financial, and if you're interested in seeing how we help our clients at Root Financial get the most out of life with their money, be sure to visit us at www.rootfinancialpartners.com.